Welcome to Discovery Watch with John Kaiser.
I'm Jim Goddard. Welcome back to the show, John.
Jim, happy to be back.
John, Azimuth Exploration published the first assays for this year's drill program at its Elmer discovery, and the stock retreated. What was the market unhappy about?
Well, Jim, there were a couple things that the market was unhappy about. But first, we had a tremendous run here. On Monday, we had $131 million worth of trading in resource juniors listed on the TSX Venture. That takes us back all the way to early May of 2011, almost 10 years back. So that was a very powerful day, coming on the heels of gold moving robustly into the $1,900 range. And even today, 1940 to 1980 was sort of the trading range. There has been a pullback, or at least a calming, in the general market. It's as if everybody said, wow, this has been exhausting, making money owning juniors. And here we have gold at $2,000. It's never made it past $2,000. It's probably going to hit that ceiling and, pull back. So we're going to take a summer breather and just back off. So partly Azimuth Exploration is pulling back in reflection of people taking a break from this bull market. But the other thing that's hurt Azimuth Exploration is that they published an update, the first batch of results from the drill program that they began in late May. And they had reported June 29th that they had completed 29 holes as part of the season. This week they published the first batch of results. They have only drilled 7 holes since the end of June. They still have 18 holes being logged, so we won't see any assays for those probably until late August or early September. And the results are a bit of a mixed bag. Now, when we went into this program, it all started with the Pat1 outcrop, which was about sort of an 80 meter by 200 meter outcrop, and they had published excellent results in January, which showed that there are multiple vein sets in there that are well mineralized with gold, and that there's an association with disseminated pyrite, which should show up in the IP surveys as a chargeability high. So they conducted an IP survey and this showed a number of targets, one associated with the Pat1 zone and 4 others in the area. So the market's hope was, wow, okay, we've got the Pat1 zone. There's clearly extent beyond this little outcrop which they drilled. And we're going to see more of these zones emerge within this overall 7-kilometer shear structure. However, the way the company has reported the results, we do know that the Pat1 zone itself now has a strike extent of about 350 meters. They have shown that it persists at depth to 200 meters. This is the type of system which can go a lot deeper, so obviously there's room to go down plunge and see how the gold behaves in that direction. But at the southwest end, they hit a gabbro unit which was not mineralized, and at the northeast end, they have several holes pending, but they didn't really have much to say about that. They also indicated that in this batch of results, a bunch of holes had been prioritized for assaying. When you look really closely at the news, they did say that the Elm 3 target into which one hole was drilled, this is one of the IP chargeability anomalies that's offset from the Pat1 zone. It was a dud. But Elm 2, into which they had drilled holes fairly early, none of those were prioritized for testing, and those are still pending. And they drilled 2 other targets, Elm 4 and 5, to the southwest. They drilled several holes into those, so that's encouraging that maybe they saw something interesting there. But they still haven't really told us anything to encourage us to hold our breath. So the market's glum conclusion is that the IP chargeability anomalies are not proving to be a guide for where this gold mineralization exists within this overall 7-kilometer long shear structure. because most of this shear structure is covered by overburden or swamp, that means they'll probably be groping their way carefully along strike from the existing Pat1 zone rather than going out there and randomly drilling IP anomalies. So that has cooled the market's enthusiasm somewhat. If you look at this 350 by 200 meter by 80 meter footprint, that's about a 10 to 20 million ton block of rock. And for every 10 million ton block at 1 gram per ton gold, that represents potentially 300,000 ounces. So this is an open, pitable footprint. Because of the high-grade, erratic nature of the mineralization, depending on where you hit these veins, it is impossible to tell from the results so far what the overall grade is going to be. They will need to do considerably more drilling, Swiss cheese this to produce a resource estimate, and chase it down dip with deeper holes. At the moment, they haven't really guided us as to what the next step is. They do still have the Piqua project on which they were doing an IP survey to extend the one they did earlier in the year to include these 2 EM conductors. Hopefully they go to work on that project and drill some holes there and get some joy, get a second front for discovery exploration going. But at the current price, the stock has a valuation of about $120 million dollars, which is about half of what it achieved when the stock was at $350 a month ago. But when you look at the Eau Claire project of East Main, it only has a $50 million valuation right now. It has about a million ounces supposedly open pitable, and it's had over $60 million spent on it. So the jury at this point is out about how significant the Pat1 zone discovery is on the Elmer project, and the hope that this was a series of sort of pipe-like bodies that repeats itself. We do not know yet that this is the case. It could be that this is just a freak local occurrence and that will have a nice, 500,000, a million ounce resource in that location. But that has taken some of the shine off the stock, along with the breather that we have in the market. So what we really need to wait for is when all the results have compiled, when they've put all this stuff together and say, okay, now we know what's going on. Now we know what we need to do next. Now the company is very cautious, and it's possible that all the things they didn't say weren't because there was nothing to say about it, but simply because they didn't want to talk it about yet. But generally, when you read between the lines in detailed news releases like that, it's a pretty good sense of what is still left to come in the pipeline. And right now, there doesn't seem to be a lot more than what people have already seen put on the table.
We'll have more with John Kaiser right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with John Kaiser. John, Galway metals moved higher today despite the juniors taking a breather. What's helping Galway buck the trend?
Galway metals is an interesting contrast to Azimuth exploration in the Discovery Exploration Fund. This part of the bull cycle is less about the uptrend in the price of gold than it is about juniors raising a whole bunch of money, taking an existing system, and drilling a lot of holes to demonstrate that it's bigger and better than it has always been. In the case of azimuth, it's in an area where there aren't any known significant deposits. So the hope was that what they reported earlier in the year was the beginning of something significantly bigger. So far, we're not seeing it get significantly bigger, or what could make it get significantly bigger. So the market has kind of lost its enthusiasm. But in the case of the Clarence Stream project in New Brunswick, it started off with the handicap that, Atlantic Canada's not the greatest place for big gold systems. Sure, you have the high-grade north and south zone that Free West found ages ago. But it's not that interesting because this isn't a place where big gold districts exist. But Galway, after several years of struggling, has managed to reach that tipping point where the market is taking it very seriously. They are now focused on this what's a sort of a 3 to 4 kilometer strike with extension potential in both directions, with the George Murphy zone at the north end, the Richard zone in the middle, and the Jubilee zone at the southern end. They've got 5 rigs on the property. 3 of them are in the middle of this zone. Stitching it all together, they would like to put out a resource estimate for early 2021. Part of this has potential to be open pittable, but it also, because of the high grade, has a deeper underground potential. And they bit the bullet in June. They raised $17 million between 44 cents hard dollars and 65 cents or 54 cents flow-through dollars. And they have a total of $22 million in the treasury. But the 2 other rigs that they have, what they call the wildcatting rigs, they have been stepping beyond this main area where they're trying to infill to produce a resource estimate. They've been looking for new discoveries. And there are gold in till and gold in soil anomalies all over the Clarence Stream project, both sides of the George Sawyer Fault, which is a regional fault, deep-seated crustal feature that separates older Ordovician rocks from younger Silurian rocks. They're both metamorphosed sediments, and these have been intruded by younger granitic bodies, which have managed to also bring along fluids. And through the structural preparation they have created in this country rock context, have allowed what they call intrusion-related gold systems to evolve. Now, the hole that they reported today is number 65, and it was a step out north of the George Murphy zone, and it was drilled to the northwest, in other words, sort of away from the main part, but testing another couple parallel zones that they had. But at the very bottom of the hole, beyond where they were expecting the existing zones to project, they intersected 14 meters that were interspersed with very visible gold. And since, well, they often get visible gold in this project, you would think, so what? It's just more of the same. It's a complex mineralized system. They will always be hitting high-grade gold and reporting it in whatever batch of holes that they release. But when you look closely at the map and that, you realize that this is offset sufficiently from that main George Murphy to Jubilee trend and potentially a parallel trend. The George Murphy Jubilee trend, it flanks the southeast side of this granite intrusive that's about 2 kilometers long and 400 to 500 meters wide where it outcrops. And when you look at the map and see where this intersection is projected to surface, you say, I wonder if the northern flank of this northeast trending granite body also is mineralized, because it would have been the same context coming up very close to the George Sawyer Fault and bringing in mineralizing fluids and prepping it. And they have got no holes in this part because, of course, drillers always like to pursue in the vicinity of where they do have mineralization. And in June, they had also intersected at the southern end, beyond the Jubilee zone, a simple half-meter interval of 185 gram gold, which is 6 ounces gold. And this has extended this in this direction, and there's a cross-structure in the area, and there's one of the highest gold and soil anomalies down there. So when the market's looking at all this and saying, this is great, they're building the bread and butter ounces within the main trend, but they also got drills stepping out probing farther beyond the limits of the known system, coming up with new stuff. They don't know the true width of this high-grade interval, or what we hope to be high-grade. It'll be a while before we get assays, and they don't know the orientation, but we know that one of those rigs is there, stepping out around it to get a feel for the geometry. And the markets in this glass half full market is just thinking, they're hitting this stuff. It's going to keep getting better. The other rig is at the southern end, probing around in the vicinity of that 6 ounce per ton interval, trying to understand its structural controls and to see how much farther to the southwest this will extend. So this is an example of the market rewarding a junior who is able to keep adding something that makes the existing system bigger and better than it is already understood to be in a context of a strong gold market.
We'll have more from John Kaiser right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're chatting with John Kaiser. John, Midas Gold is another junior which inched higher today while most retreated. In fact, Midas has more than doubled since you last talked about it on Discovery Watch in mid-April. What's changed there?
Jim, several things have changed. The first thing that has changed is that in early July, they put out a press release that wasn't the usual one we've come to expect. They said that the timeline that the Forest Service gave us for when they will be able to accept a draft environmental impact statement remains intact. It's still going to happen in August of 2020. And the story for the past couple of years, there's been always some delay. No, it's going to be later. There's been excuses about government shutdowns, COVID-19 shutdowns. And part of the problem has been that the Forest Service and all these various agencies that are all part of the permitting process do not have the skill set needed to permit not just a large open pit mine, but one that reclaims an environmental disaster site first created in the 40s when the area was mined for antimony during the war effort, and then in the post-war period for gold, and then abandoned by the operators, no cleanup ever done. It's ruined the ability of salmon to migrate upwards into the watershed upstream. And of course, nobody's been around ever to, pay for this. And this company took on this project, and Stephen Quinn calls it's really a giant reclamation project funded by a gold mine, and still with the ability to produce antimony, of which America consumes 44 million pounds a year, most of which comes from China. The rest of it comes from other friends of America like Russia and Iran and Tajikistan. And if this new Cold War that seems to be ramping up really hits a point where there's a military conflict and materials stop moving from China, then the United States has a problem getting its antimony, which is used in lead acid batteries and also as a flame retardant. And it's part of the general macroeconomy. It's not yet one of the fancy new green energy technologies or anything like that, but it is a potential serious problem for the United States if trade of this material from China ceases to take place. So the market's saying, wow, after all the skepticism that Idaho will ever permit this open pit gold antimony mine, it looks like it will finally happen. When it is published, there will be a 45-day plus comment period where the public gets to weigh in with its observations and complaints. And the Forest Service, of course, in accepting a draft, they're saying, we have done our job. We have forced the company to deal with every possible thing that could violate existing permitting rules, so that when this gets accepted as a draft, we're just looking for something really strange that we haven't found. And the kinds of comments that you will get are stuff like, have you considered the impact that voracious salmon fingerlings will have on some little minnow populations, such as the snail darters, which evolved upstream after the access through the mine was disrupted 50, 70 years ago? Can you tell us how you will mitigate against salmon once again flourishing in this spawning ground upstream? And that's the sort of stuff that they will have to deal with. So the market's starting to believe that there will be a record of decision by late 2021, which in essence is a mine permit. They also will finally see the feasibility study in the fourth quarter of this year. It will be filed after the draft EIS is accepted, and that will answer a very important question, which is how, since the PFS in 2014, has the cost structure of the stibnite mine changed? And this is really important to the value equation. When they did their PFS, they used $1,350 as a base case price, but the price of gold at the time was $1,200, so that didn't particularly impress the money. The capex was $970 million, but the NPV at 5% was $832 million, which is not really what you want to see for a project where you're using a price higher than the market price. But when you run those numbers today, it's a completely different story. At 1936, I come up with a substantially higher range of $1.5 billion to $2.7 billion, that 5% and 10% discount rate, which translates into a stock price of $3.86 to $5.71. And this is for a company which in March, when the meltdown was happening, got as low as 35 cents in the midst of doing another 44-cent financing to raise money that will take care of it until the end of 2021. But everybody wants to know, well, have we seen a capex blowout so that even at $1,900 gold, this thing is still dubious as a development candidate? So I published a report on Monday in which I imagined the old PEA numbers that sort of disappeared with the PFS because there was insufficient drill density to include the ore schedule. I reinstated that. I've used the 21% federal tax rate instead of the 35% rate, and of course that's maybe a dubious assumption looking at how about what the polls are saying as to who will win the election. And I listened to Steve Quinn's guidance, and he has told people in conference calls that he expects the capex to increase due to tariffs and things like that, which the Trump administration has slapped on aluminum and steel. But he expects OPEX to decrease slightly. But he didn't give any signals that capex is going to be like double or something horrifically bigger than was originally assumed. And that was a problem after 2011. Everybody started these economic studies when gold had ramped to $1,900, and then gold, of course, retreated back to $1,100, and we got all these huge capex numbers that killed the majors and the mid-tier producers. But now we are in a different situation. Everybody has been using lousy $1,350, $1,450 ounce as a base case price. Nobody has really undertook the effort to believe that maybe $1,900 plus is the new reality. And the reason we see Midas going up right now is the market starting to believe that these higher prices are a reality. And when I recrunched the numbers using my assumptions of just a 30% increase of capex from $1 billion to $1.3 billion, it actually it still left the project better than not that much better or worse than it was with the old PFS numbers. And so I think as long as the capex number can be maintained below a 50% increase at $1,900, this is a very robust project. And I can do something that sort of a brokerage firm analysts cannot do. I can plug $3,000 into my model, and instead of just seeing a $5 to $10 future price range for the stock at $1,900 gold, this shows you that you could get a $10 to $15 price range. So if we are indeed on the threshold of seeing gold shift into the $2,000 to $3,000 range as it prices the extreme uncertainty facing us ahead of this upcoming election, then you will see this stock adjust upwards. And it's moved from 35 cents to, as high as $1.75 in the past week. It's back into the $1.50, $60 range. So that's up 300% from its March low, but it still has lots of running room, and it's a great deal for those who are willing to believe that the Idaho permitting process finally has a timeline that's plausible. They believe that there will not be a monster capex blowout, and that gold is going to hold at least $1,900, if not establish a new range in the $2,000 to $3,000 range. And this doesn't require any additional discovery exploration or anything at all. So to a large degree, Midas has become a mathematical bet, a leveraged bet on a higher gold price.
John, thank you so much for the update.
You're welcome, Jim.
We've been speaking with John Kaiser, his website, kaiserresearch.com. I'm Jim Goddard.
Comments made on Discovery Watch are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Discovery Watch is a production of How Street Media Incorporated.